So I was on a video call with my sister the other day, helping her to set up a passive equity portfolio. And the popular method is to invest a big portion in passive, low-cost global equity funds. I know, nothing too spicy. Basically the equivalent of having 5 Coldplay songs in your Spotify Wrapped. Now what you'll find is that global market equity funds have the vast majority invested in one single country, the United States. Not only that, if you look at developed markets, you will see that the top 10 holdings will be US firms, led by the Magnificent Seven.
Wait a second.
So what's so global about this anyway? Does this make sense? First we have to understand what it means to be passive. So instead of you deciding on how much you should invest in each stock, you can let the market decide for you. If Mr. Market thinks that Apple is worth more than whatever this is, hopefully over time it will be reflected in Apple's market capitalization. That is the total market value of every stock for the company. And global equity market indices will usually weight each stock according to its size. So the larger the company is, the more influential it will be in the portfolio. However, if we sum up all the market cap for every stock in the world, our country split is going to look something like this. So the US share is a bit less than half. But this is not the same split as you see in global indices. Here the US represents 67% of the portfolio. So what can explain this difference? Is because when you create these indices, you want them to be useful. And in order for the indices to be useful, you need to take other things into account, not just the market cap. The stocks needs to be liquid and easily traded, and you don't want any ownership restrictions or lack of transparency for investors. That is why the share of emerging markets, for example, is smaller than what would be justified by the market cap alone. And the US weight in these global indices have been quite high for a very long time. And taking a contrarian view on that in the past hasn't been very wise. A portfolio that would weight each stock equally, regardless of its market cap, would have underperformed for the past 15 years. And excluding the US altogether would of course have been even worse. But how it's gonna turn out in the next 15 years is of course everyone's guess.